Hey, Mike, that's right. Robinhood is pretty closely tied to the broader markets and retail traders, specifically based on some real-time data, the recent downturn, and what we saw out of the major brokerage names. Wall Street is expecting slower trading activity. That's still where Robinhood makes a bulk of its revenue. The company has also set the bar pretty low based on its prior earnings reports. JMP Securities' Devin Ryan is expecting a modest improvement, at least from the second quarter, driven by options volumes. And as Dan Dolev of Mizuho told me, analysts are now focused more on the metrics that are within Robinhood's controls, mostly cost cutting. The company already laid off about 23% of its workforce. Analysts are looking for more signs of cost discipline in its guidance. Also watch for margin expansion and any commentary on growth outside of just trading. Rising rates should be a tailwind for Robinhood's revenue with net interest income. And finally, account growth. MAUs, or monthly active users, those still tend to be pretty tied to the markets, but watch for any churn or essentially people leaving the platform. Mike, back to you.
Yeah, Kate, it's interesting. And looking at some of the other results, such as at Charles Schwab, the giant in the industry, all the talk is about investors finding the highest yield on their cash and moving money around. And there's this novelty effect out there, and the idea that you can get 4 to 5% safe yield out there. I wonder if the Robinhood customer is seeking something like that, if Robinhood's going to have anything out there to try to invite that kind of activity outside of just trading.
Yeah, that has become a competitive play for the brokerage firms, and a lot of the fintech. SoFi has sort of moved in that direction, too, and talked about that on earnings this morning, the idea that offering higher rates on checking and savings actually helped account growth. Robinhood launched about a 3% yield on its what is essentially a savings account or a cash account. And that's a way that the fintechs are really looking to compete, even if it's a loss leader. If they lose money on that in the near term, it's a way to sort of entice people to get on the platform. They are looking now to diversify and move away from just trading. This company really was built in a zero rate environment. We saw what happened during the meme stock era that really helped Robinhood. We're here about a year and a half later, and things are looking extremely different. The company is now trying to pivot and look more like sort of a money center bank than just a brokerage firm. So we'll see if they're able to accomplish that. And a big part of that is going to be cost cutting and really the discipline that Wall Street's looking for, not spending on growth, trying to pull back a little bit and paint a picture of where this company is actually going.
Yeah, it's a story that's really washing over really all kinds of tech, fintech or not. Still a $10.5 billion market cap on Robinhood. Kate, thank you very much for the setup.